Benjamin Franklin once said, "An investment in knowledge pays the best interest." It's a powerful reminder of the importance of being informed. When it comes to investing, the real risk isn't in equity investing, it's in staying away from it. Any investment offering an annual return of less than 9%, like savings accounts or traditional fixed deposits, may actually give negative returns after accounting for taxes and 6% to 8% inflation. To beat taxes and inflation, you need returns exceeding 10%. For long-term wealth building, investing in equity is one of the best strategies. Think of investing like learning to drive a car. It may seem challenging at first, but with the right skills, it becomes second nature. The lack of knowledge often leads to misconceptions, which is one reason many retail investors stay away from equity markets. Here's the key: invest in knowledge before investing in equities. Think of buying a stock as becoming a part owner of a business. Start seeing yourself as a business owner, and the process will begin to make sense. Now, let's dive into how to take the first step toward picking the right stocks and starting your equity journey. Where to start in stock market investing? In the US, there's no shortage of advice on stocks. But before jumping in, you must assess the quality of the stocks. However, the data and financial metrics might overwhelm you at first. From balance sheets to dozens of ratios, you may wonder, what should I focus on? Many new investors start with profit growth because it's easy to find in financial statements. But focusing solely on profit numbers can be a huge mistake. Companies can easily manipulate profit figures, and a large profit doesn't always mean real cash flow. For instance, a company might show $1 million in profit but have negative cash flow, possibly due to debt-funded growth. Take Cox & Kings, a once popular travel company, as an example. Until March 2018, it showed impressive profit growth of 153%. But by August 2018, its stock price plummeted from $270 to $10, resulting in a 95% loss. It later emerged that the profits were manipulated. Even strong profit growth doesn't guarantee that a stock is a good investment. Sales numbers can be misleading too. Another common focus is sales growth, but this metric has its own issues. Sales growth doesn't guarantee shareholder benefits. It's not just about how much a company sells, it's about how much it keeps after expenses. For example, imagine you run a large restaurant serving hundreds of customers daily. While your sales numbers might look impressive, your profits depend on how efficiently you manage expenses. A competitor with fewer customers but better cost management might earn more profits. For publicly traded companies, the revenue streams, expenses, and even subsidiaries can make financial statements complex. This complexity creates opportunities for companies to manipulate data. For instance, large accounting firms prepare balance sheets for corporations, making it challenging for average investors to decipher true profitability. The metrics that matter most. So, if profit and sales growth aren't reliable, what should you focus on? The answer is return on equity, ROE. As a shareholder, you need to know how effectively the company uses your money. Is the company creating value for its shareholders, or are the promoters only enriching themselves? ROE measures how much profit a company generates with the money shareholders have invested. It's a more reliable indicator of the quality of a business and the efficiency of its management. A high and consistent ROE often signals a company worth investing in. The takeaway. To succeed in the stock market, don't fall for flashy profit or sales growth numbers. Instead, focus on deeper metrics like ROE to assess a company's real potential. Just like Benjamin Franklin said, investing in knowledge pays the best interest. Before putting your hard-earned money into the stock market, invest time in understanding how it works. Remember, informed investing isn't just safer, it's smarter. The most important parameter in investing is the return on equity, ROE. Let's imagine two restaurants, Restaurant A and Restaurant B. and you're given the chance to invest in one of them. Restaurant A is making a $30 profit on a $100 investment, while Restaurant B is making a $200 profit on a $1,000 investment. If we only look at the numbers, it may seem like Restaurant B is the better option, as it's generating more profit. However, Restaurant A is more efficient. It earned $30 with just a $100 investment, meaning that if it invested $1,000, it would earn $300. This clearly shows that Restaurant A has a return on equity of 30%, while Restaurant B's is 20%. As an investor, you would likely prefer Restaurant A. This is why it's essential to evaluate the return on equity, ROE, when considering an investment. ROE helps you assess how effectively a company is using its equity to generate profits, and it's calculated as net income divided by shareholder equity. A higher ROE indicates that the business is more efficient at generating profit for its shareholders. For example, a company with an ROE of 18% is more profitable than one with a ROE of 12%. But ROE isn't everything. It's not always about numbers. I personally prefer investing in stocks with a consistent ROE growth, or at least 20%. However, an ROE lower than 20% doesn't mean the company will deliver negative returns. The question then becomes, why would a company report a high ROE? The answer often lies in its economic moat. An economic moat, or competitive advantage, plays a significant role in investment decisions. Don't make the mistake of assuming that a successful company will always maintain its ability to generate profits. High-growth companies often struggle to sustain their profit-making capabilities over time. This is because success attracts more competition. The more profitable your business, the more likely it is that others will jump in. For example, in a highly successful restaurant, it's common for competitors to open nearby. Over time, the ability of that restaurant to maintain its profits diminishes because competition erodes its market share. Therefore, extremely successful companies often become less profitable as competition increases. This is where the concept of an economic moat comes into play. A company with a strong economic moat can continue to thrive, often by offering better products or services than its competitors. Customers are often willing to pay a bit more for a superior product. If you can differentiate your product by features, technology, durability, or something else, you can capture a significant portion of the market. But there's a catch. A better product or technology can only help in the market for so long. Eventually, competition will catch up and create something better. Researching and developing superior products can be costly, which leads to higher prices. At that point, customers might hesitate to pay more. A good example is Nokia, which dominated the mobile market from 2002 to 2010. Even if their products weren't the best, people were still willing to pay for the brand name. It takes years to build such a respected brand. However, successful brands like Apple can sometimes maintain their competitive advantage for much longer, because of their economic moat. But not every brand can establish a strong economic moat. Take the airline industry as an example. Airlines like Kingfisher and Jet Airways couldn't maintain a competitive edge purely through brand recognition. In industries like this, it's challenging to extract more money from customers simply because of a brand. One of the most sustainable ways to create a competitive advantage is by locking customers in with high switching costs. A good product at a better price will attract customers, but finding ways to keep them loyal is the real challenge. Locking customers in and making it hard for them to switch to another competitor can create long-term success. The factor that makes it difficult for customers to switch to a competitor's product or service can often be money, time, or convenience. If the cost of switching isn't high, customers are less likely to move to a competitor's offering. That's why companies can sometimes ask their existing customers to pay a premium. For instance, accounting software firms like QuickBooks or CRM providers like Salesforce or Freshdesk have high switching costs. Once you've set up your business accounting in one software, switching to another can be complicated. Plus, there are additional costs for retraining staff. It's important to note that the price for switching doesn't always have to be monetary. For example, Facebook has such a strong network effect that switching to another platform seems unnecessary, even when alternatives are available. The economic moat is about understanding the unique factors that set a product or service apart from its competitors. This could be customer base, unique features, or network effects. Identifying economic moats isn't straightforward, but it's often reflected in consistent returns on equity, ROE, over time. If a company's operating margins have been growing steadily for 5 to 10 years, it might indicate a strong and sustainable economic moat. Now, let's talk about debt. Yes, that dreaded word, debt. At various stages in life, we may rely on loans to fund big purchases. Home loans help us build our dream homes, car loans allow us to buy our dream car, and in today's world, even things like smartphones, TVs, and washing machines can be bought on easy installments. Taking on debt isn't inherently bad, it all depends on how it's managed. Businesses, too, borrow money for working capital, buying machinery, or expanding operations. However, borrowing too much can push a company toward financial ruin. If the cost of servicing the debt exceeds the profits a company makes, it can lead to a situation where the business struggles to stay afloat. It's essential to assess whether a company has the capacity to repay its debt without affecting its daily operations or profitability. Analyzing a company's ability to repay debt involves reviewing its balance sheet and financial ratios. The most relevant ratio for assessing debt levels is the debt-to-equity ratio. This ratio measures the financial leverage of a company by dividing its total liabilities by its shareholder equity. It tells you how much debt the company is using to finance its assets compared to equity. A higher ratio indicates that the company is more reliant on borrowed money, which can increase risk. Before investing in any stock, make sure to check the debt-to-equity ratio for at least the last 3 years. If the ratio is consistently above 1, it could be a red flag that the company is heavily indebted, which may signal future financial challenges. Be cautious of investing in companies with high and increasing debt-to-equity ratios, as they are more likely to face difficulties down the road. However, this ratio doesn't always apply to banks or financial institutions. These companies typically operate with higher leverage, so the debt-to-equity ratio in these industries might not be as concerning. In summary, while borrowing can be a useful tool for business growth, it's essential to keep an eye on the debt levels and assess whether the company can manage it effectively without risking its financial stability. Financial companies use various ratios to evaluate performance. Let's take a look at some companies with a high debt-to-equity ratio and see how their stock prices performed. The data is from July 15, 2014, and I'll explain it using a graph. Company 1, Bombay Rain. Debt-to-equity ratio, 1.28. 1-year stock price return, minus 21%. 3-year stock price return, 44%. Market index, e.g., S&P 500, return in the same period, 27%. Company 2, Gitanjali. Debt-to-equity ratio, 1.32. 1-year stock price return, minus 48%. 3-year stock price return, minus 76%. Market index return in the same period, 36%. Company 3, Ashdev International. Debt-to-equity ratio, 1.46. 1-year stock price return, minus 21%. 3-year stock price return, minus 8%. Market index return in the same period, 36%. Company 4, Guy and Ari Coke. Debt-to-equity ratio, 1.7. 1-year stock price return, minus 1%. 3-year stock price return, minus 73%. Market index return in the same period, 36%. Company 5, Pipavav Defense. Debt-to-equity ratio, 1.96. 1-year stock price return, minus 12%. 3-year stock price return, minus 25%. Market index return in the same period, 36%. Company 6, ABG Shipyard. Debt-to-equity ratio, 2.36. 1-year stock price return, minus 9.48%. 3-year stock price return, minus 35%. Company 7, Ruchi Soya Industries. Debt-to-equity ratio, 2.88. 1-year stock price return, minus 29%. 3-year stock price return, minus 57%. Company 8, Bhushan Steel. Debt-to-equity ratio, 2.9. 1-year stock price return, minus 1%. 3-year stock price return, minus 8.75%. Company 9, Hindustan National Glass. Debt-to-equity ratio, 2.94. 1-year stock price return, minus 1%. 3-year stock price return, minus 32.9%. One key observation from these data points is that every company mentioned here experienced negative returns over both 1-year and 3-year periods, while the overall market index, e.g., S&P 500, showed positive returns in the same time frames. This highlights a critical point. Regardless of whether the market is in a bullish or bearish phase, companies with high levels of debt tend to perform poorly, especially when market conditions are not favorable. Fast forward to 2019 to 2020, and several of these companies experienced further declines, with many disappearing or being acquired by larger firms. For instance, Ruchi Soya was acquired by Patanjali, and Bhushan Steel was bought by Tata Steel. The lesson here: stay away from companies with a debt-to-equity ratio greater than 1, declining interest coverage ratio, and a low return on equity, ROE. In any market conditions, stock performance is often closely tied to how well a company manages its debt. If the debt-to-equity ratio is rising and interest coverage is shrinking, the stock is likely headed in the wrong direction. In fact, most companies with such characteristics will only end up losing shareholder value over time. So, to recap, it's critical to monitor a company's debt-to-equity ratio along with other key indicators like interest coverage ratio and ROE. These ratios, when used together, can help you assess a company's ability to manage its debt and generate profits. For small investors, using this combination will offer a clearer picture of a company's financial health, allowing you to make more informed investment decisions. As a general guideline, if a company's ROE is below 12% and declining, and its debt-to-equity ratio is over 1 and rising, it's best to avoid it. To get a deeper understanding of a company's financial situation, you can use additional ratios such as the current ratio, quick ratio, and others, though these may complicate things for small investors. Keep it simple and focus on the debt and profitability ratios to stay ahead of the curve. With the help of ratios, you can analyze any stock in just a few minutes using a pre-formatted Excel sheet. While it might be difficult to demonstrate this in a book or text format, showing it through a video is the best way. Moving forward, we'll discuss practical methods for applying management techniques, focusing on real-life examples to make things easier to understand. A key point to remember is that companies can easily manipulate their profit and sales numbers. This means you shouldn't just focus on profit and sales growth numbers. There's a wealth of advice out there about stocks, but before you invest, it's essential to perform a basic check on some critical ratios. At the very least, check the debt-to-equity ratio, interest coverage ratio, and return on equity, ROE. Return on equity, ROE, is the most important metric when analyzing a stock. If everything else remains the same, a higher ROE indicates a better investment option. Companies with a strong economic moat can generate higher ROE over time, leading to stable and growing profit margins, and ultimately multi-bagger returns. A company can create an economic moat by offering superior products and services, building brand strength, creating network effects, or keeping customers away from competition. Companies with strong and increasing ROE, along with better operating margins and cash flow, are on their way to developing a lasting economic moat. So, avoid stocks with a debt-to-equity ratio higher than 1, especially if it's rising. Also, steer clear of companies with an interest coverage ratio and ROE below 12, especially if they are trending downward. Now, let's dive into how to evaluate management. One of the biggest challenges in equity investing is understanding management quality. Many best-selling books on equity investing stress the importance of evaluating management, but most miss the crucial details of how exactly to assess it. We all know that good management can elevate a mediocre business, and bad management can bring down even a great company. But how do you figure out if management is good or bad? Honestly, I haven't found a solid answer in any of the best-selling books I've read. Most books simply suggest visiting the company, meeting with the founder, or touring the factory. But let's be real, do you think retail investors can meet with management or visit factories? Imagine you hold 20 stocks, and those 20 companies are spread across 8 different cities. Is it practical for you to visit every company before you invest? I'm confident that for most retail investors, meeting management before making an investment is nearly impossible. Even analysts might not have face-to-face meetings with management as often as we think. Imagine you're the CEO of a well-known company, and I'm a senior research analyst at a top brokerage firm. During our meeting, are you really going to share the company's weaknesses with me? Your goal is to make sure I write a glowing report that boosts your stock price, right? So, it's clear that management is always going to put their best foot forward, and this makes me skeptical about relying on management visits alone. There are many examples where even well-known firms have lost money by trusting management's words. A famous example is when Motilal Oswal, one of the leading brokerage firms, invested over 100 Indian rupees crore after multiple meetings with the management of a popular beverage company, only to incur significant losses. That being said, attending an annual general meeting, AGM, might be a better option. At an AGM, you're not alone, there are other investors, and the management team is present to answer questions. Even better, many companies hold conference calls after earnings reports, where analysts directly ask management questions. These calls provide more transparency, as the questions and answers from multiple analysts can give you a clearer picture of the company's health. But I understand that attending every AGM is not feasible for retail investors. Many small investors live in smaller cities, and most of them work full-time jobs. So, how can you find the time to attend every meeting? Here's a simple solution. If you're unable to attend AGMs or conference calls, you can leverage online investor communities and financial platforms. These platforms often provide live updates, Q&A sessions, and discussions that give you insights into management's approach without having to attend in person. By combining these methods, you'll be able to evaluate management quality in a more effective way, even if you can't always meet them face-to-face. Let me share an easy way to evaluate management credibility. You can do it from the comfort of your home using some simple methods that I've tested over time. By doing so, you can benefit from my experience. To evaluate management, we only need 3 key inputs: shareholding pattern, dividend history, and tax rate. Our favorite is return on equity, ROE. Let's first look at how easily this data can be accessed. With the internet, collecting data is no longer a challenge for retail investors. Every publicly listed company is required to submit its shareholding pattern to the stock exchanges after each quarter. You can easily find this information on websites like the NYSE or NASDAQ, depending on the market. Institutional investors and promoters may also buy shares through block deals or bulk deals, and these transactions are reported. So, by the end of the trading day, this data is readily available on the exchange websites. Now, let's talk about return on equity, ROE, and tax rates. Both can be easily found in a company's financial statements. ROE may require a basic calculation, but it's also readily available on finance websites. Once you check this data, you'll find that the dividend history is easy to access as well. Just like ROE, you can find a company's dividend history for up to 10 years with just one click on platforms like Yahoo Finance or the company's investor relations page. Evaluating management credibility is that simple when you have these parameters at your disposal, and the only thing you need is an internet connection. Let's begin with the shareholding pattern analysis. Shareholding patterns are generally divided into two major categories: promoters and the public group. Promoters are the individuals who started the company, whether they are domestic or international, and their relatives who hold shares are also considered part of this group. The public group, on the other hand, includes institutional investors like mutual funds, insurance companies, and retail investors. Now, let's understand how shareholder activity can impact a company's performance. When promoters increase their stake, it's a good sign. After all, who knows the company better than its founders? If they are buying shares in the open market, it indicates confidence in the company. I saw this firsthand with a microcap stock I invested in back in 2012. The promoters were steadily increasing their stake over the next couple of years, which was a positive signal. Even though the company was relatively unknown and lacked public coverage, this pattern reassured me. In the end, the stock returned more than 300% on the investment. This strategy worked because I kept holding the stock as long as the promoters kept buying. As soon as they stopped, I sold my shares and booked the profits. Yes, investing in microcap stocks can be risky, but in this case, the promoters' buying pattern reduced that risk. It gave me the sense that I wasn't the only one buying the stock, the owners were in it too. Promoters may increase their stake for various reasons, but the outcome is generally positive. As a retail investor, it's not always necessary to dive deep into the reasons why promoters are buying shares. The important thing is that when promoters are increasing their stake, it usually leads to positive outcomes for the stock. However, one should be cautious of promoters who dilute equity to increase their stake. In such cases, shareholder value may decrease. But, in general, a growing stake by promoters tends to boost confidence and, ultimately, stock prices. When promoters reduce their stake in a company, it can have both positive and negative effects on the stock price. A sudden sale of shares by promoters, often called a forced selling, can sometimes lead to a significant drop in stock price. But let's take a step back and look at it from a different perspective. If promoters reduce their stake, it may indicate a lack of confidence in the company's future. For example, in the infamous case of Satyam, the promoters had reduced their stake from 10% to just 2% by the end of 2008. By January 2009, the stock price plummeted to 77 Indian rupees. This was a clear sign that the promoters were aware of the financial mismanagement, even before the scandal broke. Before the fraud was revealed, promoters had quietly reduced their holdings, distancing themselves from the company. This is a cautionary tale. If the promoters are selling off their stake, it's a red flag. However, reducing a stake doesn't always spell disaster. Promoters have the right to make profits from their investments, and their reasons for selling shares can vary. For instance, Page Industries promoters reduced their stake between 2012 and 2015, but during that period, the stock price rose by over 200%. Another example is Atul Auto, where the promoters sold off a portion of their stake in 2013. Initially, I was concerned, but after a detailed analysis, it turned out that the promoters had sold shares to institutional investors. This ended up benefiting everyone, as the stock returned more than 150% in the following year. Financial companies, especially banks, often dilute their stake to raise funds, which is usually seen as a positive move. Since banks are in the business of lending money, they need capital to grow their loan books, which in turn helps them generate profits. So, when banks or financial institutions raise funds, it doesn't always signal trouble, even though it results in a reduction in the promoter's holdings. Whenever promoters sell their stake, it's important to understand the reasons behind it. It can have both positive and negative impacts on the company. Let's talk about institutional investors, which include pension funds, mutual funds, insurance companies, investment banks, and commercial trusts. These investors often buy large amounts of stock, which can significantly influence stock prices. Institutional investors are seen as experienced and knowledgeable, and retail investors often follow their lead. There are two types of institutional investors: foreign institutional investors, FII, and domestic institutional investors, D2. Now, let's understand the impact of foreign institutional investors, FII. When FIIs increase their stake in a company, it's considered a good sign because it shows they believe in the company's future. If they reduce their stake, it may raise concerns about the company's prospects. But remember, if FIIs sell their shares, it doesn't always mean the company is in trouble. They could be selling for economic, political, or legal reasons, or simply to lock in profits. However, if FIIs sell large volumes of stock at once, it could lead to a decline in stock prices. The key to finding multi-bagger returns in investing lies in identifying stocks that will become favorites of institutional investors. When this happens, stock prices can multiply by 3x, 4x, or more in a year or two. For example, I invested in a pharmaceutical company in December 2012, when it wasn't on anyone's radar. The stock was not being tracked by brokerages, and institutional investors weren't paying attention either. But as the company's fundamentals improved, its financials strengthened, and its future outlook brightened, institutional investors began to take notice. Between December 2012 and March 2014, FIIs increased their stake in the company by more than 35%, which led to a six-fold rise in the stock price in just 2 years. The goal is to find these hidden gems before institutional investors discover them. Once they do, the stock price could skyrocket. The key is to identify stocks with strong fundamentals and a promising future, which will eventually attract institutional investors and drive up the stock price. Lastly, let's look at the impact of domestic institutional investors, D2, who play a significant role in the stock market as well. In the United States, institutional investors like banks, insurance companies, mutual funds, and pension funds play a crucial role in the stock market, much like the domestic institutional investors, DIIs, we see in India. These investors are typically experienced and well-versed in analyzing market trends and company activities. Because of their extensive research and focus, institutional investors can often make informed stock picks that influence market behavior. When institutional investors increase their stake in a stock, it tends to signal strength and can drive up the stock's price. Conversely, when they sell, it can cause prices to drop. To better understand how these moves affect the market, it's important to examine the buying and selling patterns of both institutional investors, like mutual funds and pension funds, and foreign institutional investors, FIIs. The key takeaway here is that institutional buying usually leads to stock price increases, while institutional selling can have the opposite effect. However, don't sell your stock just because institutional investors are selling. They might be doing so for reasons unrelated to the company's fundamentals. Now, let's talk about the impact of retail investors. While individual retail investors do not have the same power to move stock prices as large institutional investors, a shift in their behavior can still signal market trends. For instance, if retail investors are increasing their holdings while institutional investors or promoters are selling, it could indicate potential risks. On the other hand, if institutional investors are increasing their stake while retail investors are selling, it might suggest positive prospects for the stock. Promoter holdings play a big role in stock price movements. If the promoters of a company are buying more shares in the open market, it's often seen as a positive sign for the stock's future. However, if they are selling their stake, it could either be a strategic move to profit or a sign of deeper issues within the company. It's also important to monitor institutional investors like mutual funds and FIIs. When their stakes in a company rise, it generally pushes the stock price up. But when these institutions reduce their holdings, it can lead to a price correction. One other factor to keep in mind is share pledging, which involves promoters using their shares as collateral to secure loans. This can be risky, especially if stock prices decline. When promoters pledge shares, they take loans against their holdings either for personal reasons or to fund business operations. This is often seen as a last resort when other funding avenues are exhausted. While share pledging might not raise concerns when stock prices are high, it becomes problematic if the stock price starts to fall. If the stock value drops, the collateral becomes worth less, and the lender may demand the promoter to either repay the loan or pledge more shares. This can lead to a cascade of sell-offs, further driving down the stock price. To summarize, promoter buying in the open market is generally a good sign for the stock. On the other hand, promoter selling can have mixed implications. If institutional investors are increasing their holdings, it's typically a sign of confidence in the stock. But if institutional investors reduce their holdings, it could indicate potential risks. Retail investors' actions have a lesser impact, but a significant increase in their holdings, combined with a decrease in institutional investments, could be a red flag. Finally, share pledging can be a risky move, especially when stock prices are volatile. It's important for investors to stay informed about the dynamics of institutional involvement, retail investor behavior, and the health of promoter holdings to make more educated investment decisions. Promoters often pledge their company shares as collateral, and if they don't do so, they risk losing their investment, as they can sell the shares to recover their money. This is why promoters may see a decline in their own company's stock prices after pledging a significant number of shares. A well-known example is Vijay Kantilal Seth of Great Offshore. Due to pledging a large portion of his shares in 2009, he lost control of his own company. In exchange for his 99% stake, he pledged 200 crore. Promoters often pledge shares to raise funds for business expansion, repay loans, or make acquisitions. But beyond a certain point, pledging shares becomes extremely risky. The situation can spiral out of control for the company, especially if the promoters are over-leveraged. A good example of this is Shaw Alloys. In the mid-2000s, Shaw Alloys pledged 98.7% of their shares. The company's stock was trading between $150 and $170 at that time, and in May 2006, it peaked at $252. But due to excessive pledging, the stock price crashed, and the company's debt continued to increase. Another example is Falcon Tires. In June 2009, the company's promoters had pledged more than 78% of their shares. Due to mounting financial pressure, a year later, they had to pledge over 91% of their shares. By September 2012, they had to reduce the pledge to 31.62%. The result? A sharp drop in the stock price. There are countless examples like this, where excessive share pledging has caused stock prices to crash. So why do promoters take such risks? In times of economic slowdown or when it's difficult to raise funds due to macroeconomic challenges, pledging shares becomes the easiest solution. When a company is already burdened with debt, it may be impossible to secure more loans without collateral, and thus the only option left is to pledge shares. For investors, it's crucial to avoid companies where promoters are rapidly pledging large quantities of shares. It's important to keep an eye on the share pledge ratio. An increasing pledge can negatively impact a company's profitability. A large portion of the profits may go toward repaying debt, leaving less for dividends. This also increases the risk of a stock price drop, which can severely affect retail investors. Companies that pledge a significant number of shares often experience an unexpected collapse in stock prices. Why take that risk? It's better to stay away from such stocks. Let me give you an example of a company where the promoters pledged a significant amount of shares. Despite a strong bull market in 2014, companies with high pledge ratios performed poorly for their investors. Take the case of Cairn India. The promoters pledged around 65% of their shares, and the market value of their remaining shares was $6,131 million. Over the course of 1 year, the company's stock only returned 10.13%, while the Sensex gained 27%. In the next 3 years, the stock returned just 11.5%, underperforming the Sensex by a margin of 36%. Then there's Bhushan Steel, where the promoters pledged more than 71% of their shares. The total market value of their remaining shares was $8,623 million. In 1 year, their stock price fell by -7.31%, and in the next 3 years, it dropped 6.13%. Similarly, take Reliance Enterprises. The promoters pledged over 73% of their shares, and the market value of their remaining shares was $5,750 million. The stock performed poorly, with a 4.67% return over the year, compared to the Sensex's 27% gain. You'll find many more companies like this, where promoters' share pledging led to massive stock price declines, often by 70 to 90%. Some companies went bankrupt, and others were acquired. Unfortunately, for the original shareholders, there was almost nothing left. For your own study, you can make a list of companies where promoters are rapidly pledging large amounts of shares. Keep an eye on such stocks for a while, and you'll notice the warning signs. Avoid companies where promoters have pledged more than 30% of their holdings, especially if the percentage is increasing rapidly. Now, let's move on to the next aspect of evaluating management: dividend history and tax rates. Dividends and taxes are among the largest expenses for a company. Accountants can't easily manipulate dividend data, unlike income or sales figures. Companies may alter income and sales figures in multiple ways, but altering dividend data is much more difficult because it directly involves sharing a portion of profits with shareholders. As a shareholder, you're entitled to a dividend proportional to your ownership. A company can reinvest all of its profits back into the business or distribute a portion of them as dividends to shareholders. The ability to manipulate dividends is almost non-existent because they are directly paid to shareholders. If a company has been consistently paying dividends for the past 10 to 20 years, it's likely a sign of a well-managed business. If dividend payouts have been steadily increasing over the past 5 years, it's a strong indicator of genuine growth. A company that gives out higher dividends signals that it values its shareholders. However, don't focus solely on dividends. Capital-intensive businesses, which require significant investment, might avoid paying dividends in order to maintain growth. A higher dividend ratio and a growing dividend rate are signs of a healthy relationship between shareholders and management. In 2020, the corporate tax rate in the U.S. was around 21%, previously 35%. Accordingly, every company should report a tax rate between 25% and 30% for the year before 2019. If a company deviates from this, it's crucial to dig deeper, assess the average tax rate over the past 5 to 6 years, and check if it aligns with the current tax rate. Companies in sectors like pharma, chemicals, and IT may receive tax incentives for working within specific industries or regions, and these are usually mentioned in annual reports. If a company reports a lower tax rate over several years without any tax incentives, it raises questions about corporate governance and management quality. Now, let's look at return on equity, ROE, arguably the most powerful ratio for evaluating management quality. A high and consistent ROE indicates that management is effectively utilizing its capital. Companies that manipulate their accounts tend to inflate assets or underreport expenses, which lowers ROE. For example, if a company inflates profits, it may also report higher sales or understated expenses. This reduces the ROE, which would normally be a red flag. A company that manipulates its accounts will not be able to consistently show high ROE. Always look at the average ROE over the past 5 years. A company with an ROE higher than 20% is generally performing well, but an ROE above 20% can also signal greater risk, assuming all other financial parameters remain the same. Now, let's summarize the conclusions. A combination of good management and a strong business can result in multi-bagger stock returns. Think of companies like Apple or Microsoft. If management is good but the business is weak, stock returns will be cyclical. If management is poor but the business is good, stock returns will be mediocre. If both management and the business are poor, stock returns will likely lead to losses. You can evaluate these management tests from the comfort of your home. You don't need to go anywhere or meet management in person. All ratios and data are readily available online for free. For smaller investors, it's not always possible to visit a company's factory or meet with management directly. There are other ways to analyze management as well, like when promoters buy additional shares in the open market. This often has a positive impact on stock prices. Conversely, promoters might sell their holdings for various reasons, which can have either a positive or negative impact on stock prices. Avoid companies where promoters have pledged more than 30% of their holdings. The increase in institutional holdings can often result in a rapid boost in stock prices. When we look at trends in stockholding patterns, tax rates, dividend history, and retained earnings, they often give us a glimpse into the quality of a company's management and its corporate governance. But now, let's dive into why it's crucial to focus on valuation and why it really matters. Take Infosys, for example. Back in March 2000, the company was a star in the Indian market. But even with consistent growth and a clean management track record, it didn't necessarily translate to positive returns for investors. In fact, a similar situation happened with Larsen & Toubro, where an investment made in December 2007 didn't yield positive results until 2013. Here's the thing, sometimes, even the best companies in the world don't offer great returns, especially if you buy at the wrong price. Infosys, for example, gave negative returns for 6 years straight. Why? It's not because the company wasn't doing well or didn't have solid growth. It was because of an overvaluation. Back during the dot-com bubble, Infosys price-to-earnings ratio soared to over 100. Now think about it, if you buy a high-quality product, but you pay an inflated price, do you really expect someone else to pay an even higher price to buy it from you? The answer is, of course, no. That's why, even though Infosys had fantastic growth, it still gave negative returns from 2008 to 2013. This shows us that even the best companies can make poor investments if bought at the wrong price. The takeaway: even investing in a top-tier company is not a smart move if you're paying too much. So, by now we've learned how to analyze companies and their management. To be a successful investor, you need to know how to choose the right companies at the right price.